On October 31st, 2025, the Federal Reserve executed its largest overnight repo operation in over 20 years, injecting $29.4 billion into the banking system in a single session. This wasn't a routine liquidity operation. This was a warning signal, a flashing red light in the machinery of global finance that most people never see. While mainstream financial media focused on interest rate decisions and inflation data, something far more dangerous was unfolding in the shadows of the overnight lending markets. The plumbing of the financial system, the repo market that keeps banks functioning day to day, was seizing up, and simultaneously, the silver market was experiencing a historic physical squeeze that threatened to expose the fragility of paper price mechanisms. These two crises weren't separate events occurring by coincidence. They were connected symptoms of the same underlying disease, a financial system built on leverage, paper promises, and the assumption that physical assets will always remain available to satisfy derivative contracts. The patterns emerging from late 2024 and throughout 2025 mirror the warning signs that preceded every major financial crisis in modern history. The difference this time is the speed at which events are unfolding and the convergence of stress points across multiple critical markets. To understand what's happening now, you need to understand how the modern financial system actually functions beneath the surface. The repo market, short for repurchase agreement market, is the circulatory system of global banking, moving approximately $12.6 trillion in daily exposures through the veins of the financial system, according to the Office of Financial Research. Here's how it works in simple terms. Banks need cash every single day to meet obligations, settle trades, and maintain regulatory reserve requirements. In the repo market, banks borrow cash overnight by temporarily selling securities like treasury bonds with an agreement to buy them back the next morning at a slightly higher price. This system operates on two fundamental assumptions that are now being tested. First, that there's always enough cash in the system for banks to borrow at reasonable rates, typically just slightly above the Federal Reserve's benchmark rate. Second, that the securities used as collateral, primarily U.S. Treasury bonds, remain liquid and acceptable at predictable values. When repo rates spike suddenly, it signals one of two critical problems. Either there's not enough cash in the system, or banks don't trust each other enough to lend. When the Federal Reserve has to intervene with billions in emergency injections, it means both problems are present simultaneously. The relationship between repo market stress and precious metals becomes clear when you understand that silver and gold serve as the ultimate settlement assets when paper promises break down. Throughout history, when confidence in the monetary system fractures, capital doesn't flow to more paper. It flows to physical assets that can't be printed, rehypothecated, or created through accounting entries. The Federal Reserve's balance sheet provides the clearest picture of systemic stress. Since March 2022, the Fed has been conducting quantitative tightening, reducing its holdings of Treasury securities and mortgage-backed securities to drain excess liquidity from the banking system. By December 2025, after reducing its balance sheet by approximately $2.2 trillion, the Fed was forced to halt this process entirely because bank reserves had fallen to dangerously low levels. Bank reserves, the cash that banks hold in accounts at the Federal Reserve, fell to $2.8 trillion by October 2025, a four-year low. Analysts consider reserves below 9 to 10% of GDP as potentially crisis-inducing. And by October, reserves stood at approximately 9.8%, just barely above this critical threshold. This reserve depletion wasn't accidental. It was the intended consequence of quantitative tightening. But what regulators didn't anticipate was how quickly the system would approach the danger zone and how violently repo markets would react when reserves became scarce. The stress signals became impossible to ignore throughout 2024 as the repo market began showing quarterly strain patterns. According to Federal Reserve research published in June 2025, repo rates began rising modestly around quarter ends and month ends as banks faced increased regulatory reporting requirements and liquidity checks. On June 30th, 2024, the Fed injected $11 billion into the overnight repo market, its largest intervention in 5 years at that time. This was a clear signal that interbank liquidity was becoming strained, but it received minimal attention from mainstream financial analysts who dismissed it as routine quarter-end adjustment. The pattern intensified throughout 2024 as quantitative tightening continued draining reserves from the system. The Federal Reserve was allowing $60 billion per month in Treasury securities to mature without replacement, systematically removing liquidity. In May 2024, the Fed slowed this pace to $25 billion monthly, recognizing the growing stress, but the adjustment proved insufficient. By September 2024, bank reserves had declined $340 billion in just 6 months, falling from approximately $7.1 trillion in total Fed balance sheet size to about $6.7 trillion by March 2025. This represented one of the fastest balance sheet contractions in Federal Reserve history, and the banking system was feeling every dollar of that withdrawal. The critical breakpoint arrived in October 2025 when multiple stress factors converged simultaneously. On October 8th, an order for 1,000 tons of silver placed ahead of India's Dhanteras festival triggered an immediate freeze in the London silver market, the global price-setting hub for physical metal. The mechanics of what happened reveal the fundamental fragility of modern commodities markets. London's spot silver market operates on a fractional reserve system, where far more paper claims exist than physical metal available for immediate delivery. When Indian buyers demanded actual physical delivery of massive quantities ahead of the wedding season and Diwali celebrations, the system couldn't respond. Silver lease rates, the cost of borrowing physical silver, exploded from normal levels around 0.5% to a staggering 39% on October 9th, according to multiple industry sources. This represented the highest short-term borrowing cost for silver in modern market history, signaling absolute scarcity of physical metal available for immediate delivery. The silver market entered backwardation, a rare condition where the spot price exceeds futures prices, indicating that market participants valued immediate physical possession more than future delivery promises. This is the market equivalent of screaming, "We don't trust paper contracts, we want the actual metal now." On October 10th, overnight silver lease rates hit 32%, while silver prices surged past $52 per ounce, breaking through decades-long resistance levels. The Bloomberg headline captured the severity. Sold out in India, panic in London, how the silver market broke. Simultaneously, the repo market was experiencing its own crisis. Bank reserves fell below $3 trillion again in October, and on October 31st, the Federal Reserve executed that massive $29.4 billion repo operation, the largest since the September 2019 repo crisis that many analysts believe was the true beginning of the COVID-era financial instability. The Fed followed this with continued interventions throughout November and December. On November 1st, another $125 billion in short-term liquidity was injected through various facilities. On December 22nd, a $6.8 billion repo operation was conducted as year-end funding pressures mounted. The pattern became clear. The Federal Reserve was fighting to keep the overnight lending system functional while simultaneously dealing with the reality that its balance sheet reduction had gone too far, too fast. On October 30th, at its regular policy meeting, the Fed announced it would end quantitative tightening entirely effective December 1st, 2025, months earlier than previously projected. This decision wasn't made from a position of strength. According to Federal Reserve documentation, reserves had declined toward the $3 trillion minimum threshold level, creating stress in the overnight funding system that threatened broader financial stability. The December year-end period saw repo rates spike to 10% on certain days, a level not seen since the September 2019 crisis, despite the Fed's promise to provide ample liquidity. The reality was becoming undeniable. There simply wasn't enough actual cash in the banking system to meet simultaneous demands without Federal Reserve intervention. As we close 2025 and enter 2026, we're witnessing the convergence of two parallel crises that illuminate the fragility of our financialized economy. The repo market stress reveals that quantitative tightening has pushed the banking system to the edge of its liquidity tolerance, while the silver market disruption demonstrates what happens when physical reality collides with paper price mechanisms built on leverage and fractional reserves. The Federal Reserve now finds itself trapped in a corner of its own making. Bank reserves stand at approximately $2.9 trillion as of December 2025, according to Fed data. And natural growth of non-reserve liabilities like currency in circulation continues to drain reserves even with quantitative tightening ended. The Fed has announced it will need to begin growing its balance sheet again, quantitative easing by another name, simply to prevent reserves from falling below the critical threshold that would trigger systemic stress. This represents a fundamental policy failure. The entire purpose of quantitative tightening was to normalize the Fed's balance sheet after the massive expansion during COVID-19, removing excess liquidity that had fueled inflation. The Fed has now admitted, through its actions, that it cannot complete this normalization without threatening financial stability. The implications for inflation are direct and unavoidable. When the Federal Reserve begins expanding its balance sheet again, creating new bank reserves through asset purchases, it's injecting new money into the financial system. This occurs at the same time that the Treasury Department continues running substantial deficits that require constant financing through bond issuance. The silver market's October crisis hasn't resolved. It has temporarily stabilized through emergency shipments of physical metal from COMEX warehouses in the United States and Chinese stockpiles flown to London. Reuters reported on October 20th that tons of silver from US, China ease London spot market squeeze. But this represents drawing down inventory, not solving the underlying supply-demand imbalance. The Silver Institute projects that 2025 will mark the fifth consecutive year of structural supply deficit in the silver market. Global silver demand of 1.12 billion ounces is projected to exceed mine supply and recycling, continuing a deficit pattern that has seen a combined shortage of 820 million ounces over the 5-year period from 2021-2025. Industrial demand for silver remains robust despite economic uncertainty, driven by solar panel production, electronics manufacturing, and emerging technologies requiring silver's unique properties. Meanwhile, mine production has declined over the past decade, particularly in Central and South America, due to resource depletion and infrastructure challenges. The market structure creates a powder keg. Silver remains one of the most heavily shorted commodities on futures exchanges, with paper contracts representing far more silver than physically exists in registered COMEX vaults or London market inventories. As of October 2025, COMEX registered silver inventories available for delivery had fallen significantly as physical demand drew down stockpiles. Silver ended October 2025 with its highest monthly close in history, up 64% year-to-date according to multiple sources. By December, silver traded near $70 per troy ounce, more than doubling from its January 2025 level around $30. This wasn't speculative froth. This was a market repricing silver to reflect physical scarcity and the breakdown of paper price suppression mechanisms. The parallel between repo market stress and silver market stress becomes clear. Both represent systems built on leverage and paper promises reaching the limits of their functionality. In the repo market, banks have paper claims on liquidity that the Federal Reserve must make good on through intervention. In the silver market, futures contract holders have paper claims on metal that may not exist in deliverable form when they demand physical settlement. The trajectory from here follows patterns we've seen throughout monetary history, but accelerated by the complexity and interconnection of modern financial markets. The Federal Reserve faces a choice between two unpalatable options: allow financial conditions to tighten further and risk a credit event that could cascade through the banking system, or resume balance sheet expansion and accept the inflationary consequences that follow. The decision has already been made, even if not officially announced as quantitative easing. The Fed ended quantitative tightening in December 2025 and will begin growing its balance sheet again in 2026 to maintain reserves above the critical threshold. This represents a return to monetary expansion at precisely the moment when inflation, though lower than 2022 peaks, remains above the Fed's 2% target. This creates a stagflationary environment where economic growth slows while monetary expansion continues. The Fed's own actions signal that financial stability takes precedence over inflation control when push comes to shove. Every market participant now understands that when the banking system comes under stress, the Federal Reserve will inject liquidity regardless of the inflation implications. For precious metals, particularly silver, this environment creates the conditions for what commodity analysts call a squeeze, a sustained price surge, as physical demand overwhelms available supply and forces short sellers to cover positions at whatever price necessary. The October 2025 events provided a preview of what this looks like in the early stages. Silver's unique position as both an industrial commodity and monetary metal makes it particularly sensitive to this environment. Industrial users cannot simply reduce consumption when prices rise. Solar panels require specific amounts of silver per installation. Electronics need silver for conductivity, and these applications have no substitute materials that match silver's properties. Simultaneously, investment demand for silver increases during periods of monetary instability as investors seek hard assets that can't be printed or diluted through central bank policy. The combination of inelastic industrial demand and rising investment demand meeting a structurally deficient supply creates the potential for price moves that dwarf silver's 2025 performance. The Silver Institute's projection of a 63.4 million ounce deficit for 2025 may actually understate the problem if investment demand accelerates. Physical buyers learned from October's crisis that paper claims and physical metal are not equivalent. When you need actual delivery, you may not get it at any reasonable price. This lesson drives more buyers toward physical possession rather than paper contracts or ETFs backed by allocated metal. The banking system faces its own structural challenges beyond repo market stress. The Federal Reserve's quantitative tightening created $191.9 billion in operating losses over 2023 and 2024, according to audited financial statements. The Fed lost money for the first time in its modern history. These losses occurred because the Fed pays interest on bank reserves at rates higher than the yields it earns on the long-dated Treasury securities and mortgage-backed securities it holds. This means the Federal Reserve cannot generate the profits it normally remits to the Treasury Department, adding to federal budget pressures. The Fed's balance sheet has become a liability rather than an asset to the government's fiscal position, limiting policy flexibility going forward. European banks with significant U.S. operations face particular challenges during repo market stress due to cross-currency funding needs. These institutions must constantly roll over dollar funding to support their American operations, and when repo markets seize up, their cost of funding spikes dramatically. This creates potential stress points that could transmit problems across the Atlantic, making U.S. repo market dysfunction a global concern. The year-end periods, when banks face quarterly regulatory reporting and balance sheet management, will likely continue showing stress patterns. Each quarter end brings the risk of another repo rate spike and Fed intervention, creating a recurring cycle of instability that markets must navigate. For investors and savers, these patterns signal the importance of understanding the difference between financial claims and physical assets. A bank deposit is a claim on liquidity. You're trusting the bank and the broader financial system to honor that claim when you want to withdraw funds. A treasury bond is a claim on future dollars. You're trusting the government's ability and willingness to repay. Physical precious metals represent the opposite. They are the asset itself, not a claim on someone else's promise. In environments where the integrity of financial claims comes into question, physical assets reprice to reflect their unique properties. No counterparty risk, no ability for the issuer to dilute value through expansion of supply, and no dependence on the solvency of financial institutions. The events of 2024 and 2025 in both the repo market and silver market reveal a truth that contradicts the dominant narrative of financial market stability and central bank control. The system is not robust. It's fragile, held together by regular Federal Reserve interventions and the assumption that physical commodities will remain available at prices determined in paper futures markets. The contrarian insight isn't that a crash is inevitable or imminent. Apocalyptic predictions have poor track records. Rather, it's that the baseline assumptions about liquidity and price discovery are false. Banks operate closer to the edge of their liquidity needs than most people understand. Commodity markets operate with far less physical backing than their paper claims suggest. When stress appears in overnight lending markets that most people never hear about, it's not a technical glitch. It's a symptom of structural problems in how we've constructed the financial system. When silver markets seize up because industrial users in India want actual metal rather than paper contracts, it's not a temporary supply chain disruption. It's a revelation of how fractional the reserve system really is. The Federal Reserve's $29.4 billion repo injection on October 31st wasn't the beginning of the bailout, it was just the latest chapter. Every quantitative easing program, every emergency lending facility, every intervention in overnight funding markets represents the ongoing bailout of a financial system that cannot function without continuous central bank support. The silver market's October crisis, similarly, wasn't an isolated event. It was a preview of what happens when physical reality asserts itself against financial engineering. The emergency shipments of metal from New York and Shanghai to London didn't solve the supply deficit. They just postponed the next crisis by drawing down inventories that will need to be replenished from a market already in structural deficit. What comes next isn't a prediction, but a probability distribution. Most likely, we continue in the current pattern. Recurring stress in overnight funding markets requiring Fed intervention, periodic disruptions in physical commodity, markets quickly papered over with inventory drawdowns, and gradual currency debasement as central banks choose liquidity provision over price stability. The historical pattern is clear. Systems built on excessive leverage and fractional reserves don't collapse suddenly. They erode gradually, then accelerate rapidly when a critical threshold is crossed. We're in the gradual erosion phase, where each intervention seems to solve the immediate problem while actually making the system more dependent on interventions. For those paying attention to these overnight lending markets and physical commodity markets that operate in the shadows of mainstream finance, the message is unambiguous. The bailouts have already begun. They're just distributed across dozens of repo operations, treasury purchases, and regulatory accommodations that never make headlines. The silver shorts aren't collapsing in a single day of spectacular losses. They're being gradually squeezed as physical tightness makes their positions increasingly expensive to maintain. The repo market isn't seizing completely. It's showing intermittent stress that requires recurring Federal Reserve support. This is what managed decline looks like from the inside. The system continues functioning, but only through interventions that would have been considered extraordinary just a decade ago. The question isn't whether the Federal Reserve can keep intervening. It's what happens to the value of the dollar when intervention becomes the permanent state of affairs. The October events in both markets serve as a reminder that beneath the surface of seemingly stable financial markets, the plumbing is corroded and the assumptions are false. Bank reserves are lower than safe. Silver inventories are lower than contracts suggest. The gap between paper promises and physical reality is wider than advertised. Those who understand these dynamics don't need to predict the exact timing of the next crisis. They simply need to position themselves in assets that benefit from the inevitable interventions rather than assets that depend on those interventions never being needed. Physical silver and precious metals generally represent the latter category. The bailout has begun. Most people just don't realize they're watching it happen. In real time, one repo injection at a time, one silver squeeze at a time, one compromise of central bank independence at a time. The pattern is clear for those willing to look at the overnight lending rates and lease rate spikes that tell the real story of our financial system's health. The contrarian position isn't pessimism, it's realism about the constraints facing policymakers and the logical endpoints of the paths they've chosen. When bank reserves reach levels that threaten stability, the Fed will inject liquidity. When silver markets seize up, inventories will be drawn down. When inflation rises due to these interventions, the narrative will blame external factors rather than policy choices. Understanding this pattern doesn't require predicting the future. It simply requires recognizing the present for what it is, a financial system operating at the edge of its functional capacity, dependent on interventions that erode the value of claims denominated in fiat currency, while increasing the relative value of physical assets that exist outside the leveraged financial system. That's not a prediction. That's an observation about how the game is being played right now, in the overnight markets where the real action happens, far from the headlines and the official narratives about economic strength and monetary policy normalization. The repo market is telling you one story. The silver market is telling you the same story in a different language. The question is whether you're listening to what the markets are actually saying or what you're being told they mean.